The question I want to go back to is there's a bit of confusion with this LTV. Now you have 70% LTV for commercial vehicles and 50% for personal vehicles. But then even if personal vehicles, if you buy it brand new, it is 50%. If you buy it in the second-hand market, it's 70%. What is the logic? Why do you do that?
Second hand, I think second hand was 50%, right?
So essentially, Honorable Chair, when you register a vehicle, after some time the value drops. So it's 70% on that reduced value. When it's brand new, the tendency for the value to drop within the first 3 years is.
But when you keep it in the showroom or whatever, the car sales, prices don't necessarily drop, no? It's like unregistered.
No, the value of the vehicle will drop. So when you buy brand new.
Yeah, but then this isn't it brand like if you're importing like second hand. Now second hand meaning this reconditioned whatever, right? Registered versus unregistered.
Yes,
It's not second hand versus brand.
Right. Then this the difference you were saying, I didn't catch it, but the electric vehicles is down to 50% from 70%.
90.
Sorry, 90 to 50, right? And your justification was what?
This is the same for all same kind of vehicle. So basically, idea is that we had a large disparity on LTV ratios before this law came in. Then what we are trying to do is to move into a consistent regime where, depending on the risk, for example, the brand new vehicle, obviously you have to have lower LTV because chances of after 1 year price come down is drastic compared to used vehicle. Market prices won't come down that way.
I just want to ask you this
risk,
specific question.
Yeah.
Is there something to do with the battery of the car?
No, it's basically the risk of coming down the value of the vehicle over a period of time.
And you are saying there's nothing to do with because the battery is the most expensive thing in an electric vehicle, right?
This is one of the reasons, historically, if you look at electric vehicles, prices of electric vehicle, not new one, value has been coming down faster than the normal motor vehicle.
Is that right?
That's because of the concern on the battery that we had earlier.
That is my question.
Yeah.
My question is, are there regulations for the batteries? Can you bring any cheap battery? Right? If there's a good battery, then the chances of the value dropping drastically doesn't exist. But if you bring a substandard battery, then it can just die in like 2 years or whatever, and then the leasing company may be in trouble. Right? I'm just asking you a direct question. Is there any relationship between the value, the quality of the battery and the change in the LTV of electric cars?
No, I don't think we look at different quality of batteries to use LTV. It's basically the broad risk of LTV value coming down over a period of time.
Right. I'm just telling you because from the conversations I've heard that some batteries are of particular high standards, some are not. So that could be a reason where the leasing companies could be saying, look, this value drops so drastically, and therefore they may have issues,
Honorable Chairman, I don't think the market prices that at the moment correctly, because I don't think there is enough information to people say it is a good battery, but then you will only know after 3 years whether it is good or bad.
But I'm sorry
market,
to take...
I don't think makes that distinction at the moment.
I know this is not directly related,
Yeah,
but are there any sort of accreditation, some standard that this battery is of high quality, grade A, grade B? Is there anything like that?
No, there may be, but finally it depends on whether it's accepted by the people who buy it.
Okay,
So,
sorry, I deviated.
Honorable Chair, may I add?
It's coming. This
The-
guy sat down, yeah.
Because when come to the finance company sector, the leasing exposure was very high. So when there is an unnecessary leverage building up, macroprudential kind of intervention is necessary. So LTV was brought in as a macroprudential measure to curtail that unnecessary leverage building.
For electric vehicles?
No.
For all vehicles?
For all leasing product.
Yeah. One question on the gross loans and the receivables chart. So there is a stage 3 loans of about 9.7% reduction. But is this stock based on the loans that went bad in this economic crisis and the COVID period, or are there like fresh stuff? Have we got rid of the stock of old loans? How the banks are doing? Like, do you have a view on that? Because banks must be carrying old loans and doing nothing about it, because now last year they restructured only about 600 odd loans out of 1,300 who came to the banks. We wanted the businesses to come to the bank, say to negotiate by last year March, and there was about 1,300 who came out of 12,000. And in 1,300 also only I think 400 got restructured. So it looks like this 9.7 consists of old stock of non-performing loans. How do we clean this? How do we flush this? Do we have a strategy, or like should they go for parate? And
DBS, can you clarify that? What is the classification, loan, old and age-wise?
As of now, the impaired loan portfolio is 1.3 trillion, and this includes all the bad loans, the loans which went bad during the crisis and thereafter. So the NPL ratio has come down from 12.3% in 2024 to 9.6%. That's basically largely because of the loan growth. We have had 21% year-on-year loan growth last year.
the stock remains same, no?
Stock almost, slight reduction, but largely the same.
Right. Can we go back to those 3 slides and then we'll proceed?
Chair, I just need an answer for that. What do we do with the old stock of 1.3 billion? It's not resolved at bank level. Do
there's a
central
asset
bank
management.
does something to do with it, or are we going to carry the debt weight another few years with having a higher stage 3 loan ratio?
I guess they have to either write off or they have to recover the liability.
There's no direction from the central bank further, right?
Need that the procedure, no?
Yes, sir.
No, it's not moving now, Governor. We gave circulars after circulars, guidance after guidance. That 1.3 trillion is not coming down.
Come down only by the businesses if they are revived and they start and repay the loan.
They can't.
If they can't, basically I don't think banks should take the depositor should take that cut. What you are asking is the depositor to take the burden and write it off.
Banks are making substantial money.
Again,
Now, early the problem was,
That
early the
50%.
problem was capital adequacy is low, so you can't do anything. Now, capital adequacy is beyond the requirement of 19.8. So, that argument does not fit now.
no, that's it. Capital is for them to expand the loan portfolio. If they are capital, they can expand the loans and give more
There's a
credit to
case to the bankruptcy of all these businesses, so it's not normal time that these businesses went down.
But then who should take the bill? Who should bear the burden of the bankrupt company? Is the depositor or the government? So then
Hey,
out of profitability, they pay 55% to the government as tax.
But there's a deadlock. I'm just tabling that there's a deadlock. It's not moving either way. I don't know whether it's good, healthy for
no,
the system
it's
or not.
moving very rapidly with the parate.
Banks are scared to do that also.
Recovery process, even for banks to give credit to good customer, there has to be a strong credit recovery process. Without that, banks will be reluctant to give credit to even good customer.
Agree, Governor. These were good customers before 2019.
They have become bad now. That's any business that you have cycles. But who should take that burden?
So, Governor, are you saying that the government should be lead? Is that the position of
Yeah,
the?
it's a government policy. If you want to support, you can
You have to
spend
support it
taxes
through
money.
government policy.
Yeah.
Yeah.
Yeah,
It's a government
1.3
policy.
trillion.
Or we should allow failure and
So yeah, bankruptcy laws, this kind of thing, to someone to take the business and carry it over and let that person, bailed out of the.
Yeah, we were told here at this committee a bad bank was being set up, but I don't see any movement towards that. A bad bank was set up, then those assets can be
Yeah.
transferred.
Honorable Chairman, I think there is this distinction between between the industry and the industrialist. Now there are a lot of industries which have got into difficulty, which can be saved with more capital infusion or better management or whatever it may be. They may have got into difficulties because of various requirements. But then the problem is the existing owners would not want to allow that to happen, because they want to retain control even though they don't have the capacity to put in what is necessary. So you need to find a mechanism. If you have a proper bankruptcy law, it works where the business will be preserved. The businessman will also get something out of it, and because he won't lose everything. But here, without that, I think everybody loses. The banks lose, the businessman loses. So the enterprise also doesn't function. No employment also. So
Now the law is being, it's stable, it's gazetted. It's just that the historical piece that we have to fix, no? So why I ask this is, now our banking system, the financial stability we discussed, will carry 1.3 trillion next year also when we meet here. So that's,
The total asset base.
Hmm?
Compared to asset
yeah,
base.
so
of 20 trillion.
as a ratio it will keep coming down.
Yeah.
If that is okay, that's
no, and also, okay, they will carry it, but the net exposure will reduce because they will be required to make
The loans are increasing.
and also they have to keep making provisions. They can't just carry it. So from a what you call the banking strength point, but that ratio will remain. That you are right,
yeah. So
because
when
that
I
which
said
doesn't
the
look right.
profitability
Yeah.
member, now if they carry for 3 years, they obviously has to provide, right? What is
So
the-
they have to progressively
yeah,
provide. They have to keep providing. Progressively.
Okay, there's a solution for the industrialist.
Through
No, it's okay. Just keep it there. Yeah, we finished the finance company sector, financial sector, and then move into the 3 slides. So
We have to be concerned about time also. The question was, since we are in the discussion on credit, we might as well just finish that credit 3 slides and then proceed. Let's go through it.
yeah, if I quickly move into the finance company sector, as like bank supervision department, the non-bank financial supervision department also issued a number of directions and circulars to strengthen the resilience of the finance companies and other finance institutions. The first one, I can say that the liquidity risk management direction was issued to establish the robust liquidity risk management framework. And the second one, the maximum interest rate on deposits and debt instruments, the direction related to that also issued. And these are related to the finance companies. And the third one is about the microfinance companies related one, where the credit risk management direction was issued to establish the effective credit risk management framework. And then the minimum core capital requirement of the primary dealer companies was sort of direction issued to provide the financial buffer to absorb the potential risk and unexpected losses. Then as like banking supervision department, non-bank supervision department also issued the relief measures to assist the individuals and businesses affected this recent cyclone and flood disaster. And they also carried out the 21 on-site supervision as well as 4 spot examinations. Like the banking sector, we can see the finance company sector recent development. The cross loans and advances of the finance company sector grew by 51.9% at in 2025, and again the profitability ratio, ROA and ROE again increased at end by end 2025 compared to the 2024. This is mainly due to the increased profits, and capital adequacy ratio overall of the finance company sector remain well above the minimum requirement level. And here also the liquidity assets of the finance company sector, even though it's continued to remain well above the regulatory minimum requirement throughout 2025. These are the sort of recent development of the finance company sector. Having said that, if I move into the other sectors which are such as payment and settlement system and financial inclusion and other things, the payment and settlement system, the department reviewed central bank reviewed the fintech regulatory sandbox framework and revised it in 2025. And then RTGS, the large payment, supporting the large payment system of the country. RTGS maintaining the high availability, and it recorded 597,859 transactions amounting to 429 trillion in 2025. And again the money value value transfer service providers were registered and related directions were revised. And if I move into the regulation side or resolution side, order was issued under the Banking Act to extend the resolution provision relating to the licensed bank and licensed finance companies. And meantime, the deposit insurance schemes administrated and operations are well managed, and the Financial Stability Fund was that also the manage as well. And if I move into the financial inclusion, implementation of National Financial Inclusion Strategy Phase 1 is about to complete, and it's with the support of IFC developing the Phase 2 of the National Financial Inclusion Strategy is in the progress. The development of the financial literacy roadmap of the Sri Lanka is also under the progress with the UNDP support. And if I say about the financial literacy in Sri Lanka, conducted the financial literacy program physically through and digital media to transform the financial behavior of Sri Lanka.
Honorable Chair, just one question on that. On National Financial Inclusion Strategy, can you elaborate more on that? What does that, what are the pillars of that? What are we expecting? What are we promoting? What is that? National Financial Inclusion Strategy.
Yeah, this has been going on. This is the second 5-year financial inclusion strategy. We had an earlier one. This is covering large areas: consumer protection, financial inclusion, financial literacy, and also digital payments. This is a 5-year plan with all the. We are giving the leadership with other stakeholders, even the Education Ministry, revising curriculum, addressing, including all these things are part of that strategy. So this is basically we are heading this one with Ministry of Education, Ministry of Industries. There are several other ministries also involved as stakeholders that come up with this 5-year strategy, and we are in the process of implementing them.
So the target is to include who into the financial system?
Yeah, I think this is national financial inclusion. Even the sustainable finance is also part of that strategy. There are components, 5-6 components, different stakeholders taking responsibility, each and every responsibility. It's not 100% us. Right. We have financial inclusion and financial literacy part, working with the Ministry of Education on literacy, inclusion and promotion we are doing, and also payment and settlement, digital promotion we are doing with payment settlement department with other Ministry of Digital Economy. Likewise, this is a much broader consultative process And this is, I think, you can make a presentation there.
Yeah.
I think, Dilipshin, can you elaborate on that? I think it's AG.
Financial inclusion strategy has 4 pillars: financial literacy, SME financing, digital inclusion, and then financial consumer protection. So financial consumer protection, the Market Conduct Supervision and Consumer Protection Department of the Central Bank is attending. When come to digital inclusion, it's the Payment and Settlement Department which is taking the lead. Financial literacy is done by the Central Bank, by the Financial Inclusion Department. And then come to SME financing, we are collaborating with the Ministry of Finance and the Industry Ministry. So Governor is chairing the National Committee on Financial Inclusion. We are the Secretariat, the Central Bank. We have a committee comprising of stakeholders. So we are done with the phase 1 and we are developing the phase 2. For that, there is a national level survey going on with regard to financial inclusion. We have to assess the level of inclusion to develop the phase 2.
Are you looking particularly at women's inclusion into financial?
Sorry?
Is there a particular focus on women?
Yeah, women is, because when come to financial literacy, women is one group that we are targeting, and inclusion also women, youth, there are several segments.
Yeah, that's all about the presentation.
Thank you very much. So we'll take the other 3 slides now, please, Doctor.
Thank you, Honorable Chair. So we have some updated slides from the last meeting on credit. So, yeah. So this chart shows the private sector credit, mainly from the financial institutions to the private sector granted credit. And if you see year-on-year growth, so we see in February around 28% year-on-year growth. The momentum in the private sector credit has been continuing in 2025, and we see a small drop in January and February. It's seasonal, but we expect the growth in private sector credit to continue, but not as much as we have observed in 2025. But if you see the institution-wise credit, so as you can see this chart table to your right, top right, and expansion of private sector credit in 2025, it's around 2,421 billion rupees. So those are from 3 main institutions. One is LCBs. The growth expansion from LCBs is around 1.6 trillion, and LFCs, licensed finance banks, around 800 billion, and LSBs, it's a small amount, around 39. So if you see the share of these institutions in overall outstanding credit, 73%, almost 3/4 of credit has been disbursed by licensed commercial banks, and around 18% from finance companies, and the rest 9% from licensed specialized banks. If you see the sector-wise credit distribution to the private sector by licensed commercial banks, so we see the broad-based expansion in private sector credit. So this chart to your left shows quarterly credit expansion for each sector: agriculture and fishing, industry, services, and personal loans and advances, and 4 quarters in 2025, and also first 2 months in 2026. But if you see the chart to your right, that shows annual expansion in 2025 for each sector, and the services sector is the most expanded sector, or mostly credit disbursed sector, around 42% of the total expansion. And then industry sector, it's around 30% of the total expansion. And then personal loans and advances, it's around 20%. And agriculture, it's just less than 10%. But if you see further breakdown in subsectors of credit expansion, so again we have given here the 4 sectors, starting from at the top of the chart, it's agriculture and fishing. So agriculture and fishing is basically, if you take as a share of GDP, it's around 7% of GDP. And contribution to outstanding loans as at end 2025, it's around 9%. And as you can see, paddy, tea, coconut, so those are the main sectors that got credit from in the agriculture sector. The industry sector is around 38% of outstanding loans, and as a share of GDP around 30%. And in that sector, it's the mostly expanded or the credit disbursed was a construction sector and machinery, fabricated metal products, and transport equipment sector. In the services sector, that's again around 30% of total credit, outstanding credit. 30% is from in the services sector, and in the share of GDP, that's the highest share, around high 50s. And so in that sector, wholesale and retail trade, and also financial and business services, those sectors got the largest credit disbursement in that services sector. And personal sector loans and advances, its contribution to outstanding loans is around 22%, and the pawning is leading in that sector. And this chart shows the distribution for January and February. Due to time constraints, I'll skip that one. And if you see maturity-wise private sector credit trends of LCBs, mainly LCBs, so this pie chart to your left shows the leftmost pie chart. That's a tenor-wise outstanding credit stock as at end 2025. And we see, so we have divided into 3 main tenors, short term, medium term, and long term. And short term is less than 1 year, medium term is 1 to 5, and long term is the rest. And the short term loans around 42% outstanding LCB sector loans, and medium term around 23%, and long term around 35%. But if you see the credit expansion in 2025, that's the other pie chart in the middle, and we see more credit towards a longer end. Long term around almost 50% credit expansion is towards a long term. And
when you say 50% in value terms, how much is it?
Value terms, it's 950, honorable member. It's here in that pie chart and also in the table.
So these are 2,400 billion broken up into those sectors, you say?
This is from licensed commercial banks only.
73% what is broken up?
Yes.
And of that, 50% you're saying 900 billion is for long-term lending.
Yes.
900 billion.
950 actually, to be exact. So 900, yeah, it's short term.
Short term.
Yeah. It's long term.
Short term, yeah.
Yeah, long term around 479. Yeah, it's my mistakes. 1/4 is around for long term credit.
So out of a year's 2,500 billion, the credit creation for long term is 25%, which is roughly 470 billion.
479, yeah. So basically almost 25% of LCB credit expansion in 2025.
Right.
Any reason?
Just tell us, where does this credit creation go in for the leasing, pawning, and credit cards? That's also part of the credit creation. Where does that seep into in this structure?
So if you see, so this is the basically the honorable member. This is the product-wise credit by finance companies. So this breakdown shows. So if you see this particular chart in row in 2025, So that's the product in the outstanding credit, that's around 2.3 trillion of finance companies. So this shows the product-wise credit. And we have highlighted here, this basically finance, leasing, hire purchase and vehicle loans. So those are related to vehicle loans. So if you see vehicle related loans in 2025, around 1.5 trillion from finance companies. And your question again, if we can, honorable member?
Yeah, that the credit creation that is gone to pawning, leasing and credit cards shows a phenomenal increase last year. Where does that, I asked, where has it seeped in this lot? You said leasing has gone into the non-commercial, non-banking sector, right? Where have the others gone? Private consumption?
65%.
Remember, it's very difficult to, so for example, if you take credit cards, it's very difficult for us to say what exactly that has been used for. It is short term, yeah. So yeah, we have that overall figure, but I mean, for which purposes, we do not have that information.
And pawning also is a very big sector. Where is that gone?
Pawning, yes.
So out of the 2,400 I'm looking at, is the leasing, pawning and credit card sector had shown a reflection of about 1,700. Is that right or wrong? Where if long term is 400 of the 2.6 or 2.5.
So, honorable member, it's shown here. So the pawning is around 238 billion US rupees.
238 billion.
Yeah.
Right. So that's 10% of
Yeah,
the
for commercial, this is commercial banks.
commercial bank.
So that's around 1,600 billion altogether. Expansion around 1,600 billion. Commercial banks credit expansion around 238 for pawning.
Of commercial bank.
Yes.
Right. Then leasing.
Leasing. Yeah. So we have the, yeah. So here we have the sector-wise, economic sector-wise.
We can't see it. Only what you're saying is what we can.
Yes. For financial sector, this is for financial leasing. Around 700 in 2025. 760 billion out of 2,323. These are for finance companies.
Yeah, but
Leasing.
You said the total credit creation on 2,600 billion or 2.6 trillion.
Yeah.
So then it's broken up to 73 into banking and 23 into others.
Yeah.
So overall lending, when you look at it, what is it? Forget whether it's banking or non-banking.
Overall lending, financial leasing.
No, overall on the leasing, yes, that's right, for leasing.
For commercial banks, product-wise, we don't have, honorable member.
Total leasing.
Total leasing as the loan portfolio.
We don't have.
Honorable member, the classification of loans for commercial banks and finance companies, they are done in two different ways. So it's very difficult for us to match the two,
Yeah,
I mean,
but
add the two
finally,
together.
Leasing from both sides, leasing. No, I
Yes,
only
so
want
what
to
we
know
have done is, in that purpose-wise breakdown, it's broken, I mean, leasing of commercial banks,
if
that's
you
broken
can
down
just
into.
give a very lucid answer as to the 2,600, be it non-banking and banking, total leasing, pawning and credit card, what's the total of the 2.6?
DBS shares, it's around 200 billion.
Yeah.
Yeah. Plus this 780, it will be around 980. Leasing.
when come to leasing, non-banking sector, it's out of the total exposure, 64%. So that rationalized the LTV intervention.
Simple number, yeah.
No, yeah,
I want to show as to how the
I think that,
where is the economy grown?
no,
Where is it grown?
I think let me clarify here. Finance companies classification is that owning, leasing, and other. There are three major categories. So that's their business. In come to banks, classification is that industry, services, agriculture. Within that, there could be leasing in agriculture, there could be leasing in industry, there could be leasing in services as well. Depending on the sector, that's classification is on the sector. That's why you can't have a total leasing of the bank sector and compare that with total leasing in the finance, because depending on the business activities, classification is different.
but isn't there a cross classification? Can't you find out within agriculture loans, Governor, how much went as loans, how much went as leasing from machines, etc.?
That breakdown is not there.
So that was included in the report that we submitted.
I think
we don't
we
have that
submit a report,
information.
probably
Okay.
that report has a lot more information. That you asked for a report, we submitted the report.
Okay.
Honorable Chair. So this is the SME sector credit extended by SME sector by the licensed banks and financial companies. And so as of end 2025, what we see is around 2,900 billion outstanding loans. And if you see the share, it's mainly a wholesale and retail trade. That's around 24%. And then agriculture and forestry and fishing around 15%, and construction and infrastructure development around 11%. Sorry, it's a 153, around 5%. You can.
Yeah, those 4 slides, these are updated from the previous one, so you can send it to us.
Sure.
We can share. I mean, from the big macro question is, are we happy with the way the banks are lending to the economy?
We can see last 2 years, especially last year, growth of 5%, reflecting the strong growth in credit by the banking sector to the private sector. So they have been shifting from their lending to from the public to private sector. Share has been increasing. There's a crowding impact happening in last year.
Yeah, but then your slide just a little while ago showed that in 2025, most 50% of loans were short term, so that cannot be for industrial purposes.
No, this basically depending on businesses. Usually, all the time there are large chunk coming from short term.
Honorable Chairman, that is a. But what you need to bear in mind is banks are lending out of short-term deposits because the issue is we have a fairly 30 to 40% in overdrafts, which actually is supposedly revolving, but quite a lot of it is actually continued over a period of time. It is like permanent credit. So that classification of long-term and short-term, technically an overdraft is repayable on demand, but if any bank tries to recover on demand, I don't think that's going to work that quickly like that. So this tenor issue is always a problem because so they are also careful to make sure that they match their deposit profile with their tenor profile for the advances, because they have to do that, because otherwise their various ratios will go out. So I think when you say 25% is long term, that is definitely long term. But within that overdraft section, which keeps on churning around, also there is a component which is long term. I mean, which keeps on. I mean, either revolving or basically only small part of it revolves. The rest is like hardcore.
But Mr.
So,
Fonseca, the
yeah.
economy is more or less a staying alive exercise. It's
Well-
not driven in any long direction at all.
You can't
Well,
really,
That's the unhealthiness of it.
No, the thing is, credit goes to where economic activity is. it's not the other way around.
Yeah, but these are not autopilot. You have to direct the economy to move towards some direction. Yeah, you can't expect, just look at a return of a
Yeah, credit goes where the
banker's
profit
thing
is then,
not
no?
sufficient. You have
Yeah.
to, who is looking at the growth aspect of this country then? If you are looking at a shareholder's return, who is looking at the growth of the country?
5% growth, if it is not sufficient and it should be more, so then there is a
But
whole lot of other policies that will have to be put in place to drive that. So
But do we not identify a gap here in long-term investment? I think that's the, in
If I may, Honourable Member, if I may, I think to reiterate what Mr. Fonseca said about credit reflecting where there is opportunity. And I think we have to also be mindful that if imagine the flip alternative where credit is being directed artificially where there isn't sustainable opportunity, and then we are likely to have a problem later on. So the solution to that has typically been in other markets where there is a suite of other policy instruments used to enable credit going into sectors that the government may want to promote strategically, for example, certain export sectors, but that can't necessarily be done with just directing banks to lend to a sector. So already there are some of those other policy instruments coming in. The credit guarantee institution is one, where you're trying to de-risk sectors that otherwise may not be reflected in this portfolio. That de-risk those sectors, banks may be more willing to lend. Also so for example, if you have the SME sector, where if you're saying banks have been risk averse because we've had successive economic shocks, which have hurt SMEs, which have then made banks more risk averse to SMEs. Now, if you want to promote SME lending in an upswing, you try and accelerate that by offering this credit guarantee. So then you might also need to look at the government's role in that credit guarantee institution. Is it sufficiently capitalized? Can it give a sufficient amount of cover?
There, in figures, how much is it? We know the story that can go on.
If I may
In real
just,
terms, what's the value?
if I might just complete those other options, and I think the other is on the source of funding. So typically, if, as my colleague said, if it's short-term deposits that the banks have access to, they will lend accordingly. But if they're starting to access newer instruments, for example, green bonds, to lend into new sectors like renewable energy, it will be longer term. If in the past the development banks were able to access highly concessional, near grant funding from development partners, but that era is over. So that's why I think a suite of solutions where you have the credit guarantee piece, you have longer term funding sources coming in from all kinds of different institutions and sources, as well as the support to identify and grow those industries. Because if there is no support to identify where is that next growth coming, can we accelerate the discovery of that next sector? For example, through the export strategy, which the government is championing again. I think those then help push the banking sector to identify those new opportunities. But at the moment, they will identify where the opportunities are, seeing the economic activity at this point in time.
On what is the total disbursement last year? If you have data right now. Don't have. They don't have. Right, okay.
I have to go. I have to speak. I have only 5 minutes left. So unless somebody wants to take the chair, or else we can conclude if there's no other questions. But I just want to point out, we looked at your report, 512 billion in vehicle loans through banks, through finance companies, 470 billion for 11 months through banks. So that's about $1 trillion, and it's still not complete. It could be a little bit more. I don't know what the number was for December. So if you say 500, so it's over $1 trillion went into leasing of vehicles.
If 250 has gone for pawning, and the credit cards have taken another 200, so then you know where the lending is. And this is why even from the last meeting, would like to see some consistency in this information. We will like to get what we want, not what's been dished out to us. So can we get a statement, because I'm not sufficiently happy with what we've got. We've been mistiness. So get a report sent.
They have sent the report, but only thing is that is till November. So I guess you can update it to,
Can update the report.
yeah, update to December. So
Yeah, but
essence,
report will come next year. Why have we got till November?
no, that is what they have sent us in the previous report.
Yeah, so they can
Whatever you sent to us was until November, and that's what 470 is till November. So you can update it and send it to us,
But proportionately, it will have the same.
pretty much. So I'm just saying roughly $1 trillion there. Members, do you have any other?
Can we get the breakdown? Can we get the
I don't see why they can't. I mean, what this gentleman is saying is that if it is agriculture services and industry, whether within that leasing can be brought in separately, but obviously you can. That's the reason why you gave us in the report that it is 470. So just update it and send it as just a note to us. No need of a big report. Anything
But of
else?
course, Chairman, now even though finance company leases for vehicles, there is a significant component of it which is also income generating. But in the current context, I mean, you have your Ubers, the Pick-me's and all of that. I mean, so it is not entirely for personal or consumption. I mean, there is.
But
I mean, it's very-
non-tradables, no?
Sorry?
It's largely non-tradable sectors.
No,
that
yeah,
they are
yeah,
lending
it's it can be for tourism, it can be for various ways. So, I mean, that breakdown, I think that granularity, I don't think we have information to that extent which is reliable. I mean, that is, that I think is a, well, unfortunate situation that we have. But so it's not sort of all that people have bought cars and are running around. I mean, there are people who are generating livelihoods, income also, but it's very difficult, I think, to say what that component is. I mean, that is a.
And the leasing increase is going to the tax benefit that also accrues from it. So I think a lot of them going for that, for tax purposes as well. But still, overall, it's a borrowed economy.
No. So, well,
So it's a 4-5 year borrowed economy is the
Well, I mean, their objective is to maintain price stability domestically. So these things are technically irrelevant to the board. So that's the debate. You know, that's why we wanted to have the treasury here today. Unfortunately, they haven't come. Gentlemen, if I don't leave now, I lose my last 5 minutes, and I need to say something in reply to the Honorable President's remarks.
Get this thing, the total credit in government and private sector broken up into long-term, short-term. If the 414 private credit, how much of that is housing? We should get to know what the breakup is.
I mean, this is really the question that we had last time also and previously, that you know, that the committee would like to know where the money is going and whether it is, you know, what is it going for.
we understand where you are coming from. So I
Yeah.
think I'm sure there is information available which we need to cut and dice and.
Are you all in such a situation that you're unable to provide this information?
No, it's not a question of providing, it's a question of
We have provided all information asked by the committee up to November. We have provided, so we can update that. It's not that
So
we are
why
not providing, we will provide.
why don't we do that, Governor? So you know,
We'll
so then we have a
update what we have
updated
provided up to
version,
November, to latest up to March we can do.
right? Is that okay, Honorable Member?
Well, I'm not, but if we can get the same information for the last 3 years, then we'll know where we are heading, where the economy is heading.
And that is not a problem. I mean, certainly they can give that to us. I mean, for a trend, we can see that. Yeah, I mean, you know, I think we need to appreciate the member's question, you know, as to what he's trying to understand, you know, what he's trying to
If I may
get.
summarize, the IMF is interested in fiscal consolidation. You all are looking at price stability. Who is looking at the growth aspect of this country? Somebody has to be looking at it. And surely if we as members are unable to get this information, we are in a very sad plight.
we have given all the information, Honorable Chairman, we have asked.
Yeah,
So
no, I mean,
we will
no, so this is the issue, no, I mean,
No, there are two things, Honorable Chairman. We have given all the information that you asked, we can give also future. But the who is responsible for growth is a different question.
so
I
that
don't
is,
think-
that is the issue. That is the
That's
issue.
not the question we can ask. That's
So
a parliament and elected
yeah, so-
officials
so-
and parliament will have to
Yeah,
answer.
so
It's
that
not our
is why, that is specifically the reason why we had wanted the treasury to understand this coordination. You are perfectly right. You are saying that is none of our business. It is none of your business. Why are you worried about growth? You have nothing to do with growth.
We don't have the instruments to drive it either.
Mr. Fonseca, right? You need productivity improvements. You need, I mean, that's what you need to have growth. Monetary policy can't drive growth. It's basic. Monetary policy cannot drive growth. I mean, you need more coconuts, you need more fish, you need more machines, you need more of real things, not money. Right? So that is not your responsibility. So that is the law. I mean, unless we change the law, Honorable Minister, then this becomes an academic exercise. So it's up to you. You are in office, not us. So, but that coordination is what we wanted to understand. Is there some coordination? Do you talk about matters related to growth? What happens? So that is that discussion that is elusive thus far, which we shall get one of these days. So, honorable members, if you don't have any questions, I may not be able to get my 5 minutes, but I'll try. Is that okay? Right. Thank you, ladies and gentlemen. Thank you. Meeting is adjourned.